Hey everyone! I am just one person hidden deep in the countryside, surrounded by silence. But I built BlockSonic to speak with the entire world. Here, you don't get noise. You get the pulse of Bitcoin every single day, distilled into pure essential updates. No teams, no sponsors, no filters. Just me, a signal from the quietest place on Earth, bringing you the most important Bitcoin news before the world wakes up. With BlockSonic, you don't need to search for information. I research, I write, and I tell the story behind every headline. I do the digging. I chase the truth. All you have to do is listen. Today, the news delves into a cautionary tale for investors. A silver cycle appears to peak amidst market dynamics that echo past patterns. We'll explore how silver's shimmering illusion may signal a market at the precipice, with volatility trading entering a new era. Meanwhile, Bitcoin lingers below its highs while gold shines, reflecting a shift that sees shiny metals commanding the stage. As Bitcoin's path weaves through these financial tides, we'll also look at ARK Invest's bold ETF moves and BlackRock's venture into Bitcoin income strategy. Amidst this, the U.S. crypto market faces structural challenges in a legislative stalemate. Join us as we navigate these intriguing intersections of metals and crypto, unfolding the implications for investors and markets alike. Silver's shimmering illusion. A market at the precipice. Unforeseen volatility and historical patterns raise alarms about silver's precarious position in the market. Every market witness to a bull run faces the looming shadow of its peak. A moment whispered with caution, yet anticipated with curiosity. Investors, in their quest for equilibrium, often invoke tales of foresight, akin to Michael Burry's prescient warning of the housing market in 2007. We find ourselves in a similar juncture as silver's meteoric rise aligns with heightened volatility. The ratio of Bitcoin to silver hovers near 780, a figure that echoes the zenith of 2017, when Bitcoin soared to $20,000. The ratio's convergence with the levels of November 2022, when Bitcoin dipped to $15,500, signals a precarious juncture for silver in its relation to Bitcoin. This suggests a potential vulnerability for silver, as its luster may be dimming amidst a volatile market. Silver's ascent, nearly 300% over the past year, met a harsh reality as prices plummeted 15% on Monday, retracting from a brief high of $117 per ounce to settle around $112. Historically, local peaks have clustered in the early months of the calendar year, with notable instances in February of 1974, January of 1980, February of 1983, and others, each marking significant price milestones. The historical echoes suggest that silver may be at the cusp of another cycle peak. If history holds its course, the precious metal might have reached its zenith, poised on the brink of a potential decline. In contemplating these patterns, we must ask ourselves, are we witnessing a transient shimmer or the dawning of silver's market twilight? We invite you to share your insights and reflections in the chat as we ponder the unfolding narrative of silver's market journey. Crypto Lull unveiled as shiny metals command the stage. Bitcoin and Ethereum stagnate amid scarce liquidity, while gold and silver surge, revealing a shift to safer assets that also lifts select crypto tokens. The digital currency landscape finds itself constrained within tight borders this Tuesday, navigating through an environment marked by minimal trading volume and liquidity scarcity. The daily trading volume for Bitcoin, valued at $87,941.61, saw a decline of 25%, dropping to $35 billion over the last 24 hours. Similarly, Ethereum's trading volume, priced at $2,912.42, decreased by 21% to $24.6 billion. This ebb in volatility appears linked to a widespread indifference within the crypto market, coinciding with an exhilarating surge in the valuation of precious metals. Currently, gold trades at $5,085 after setting a series of record highs over the past week. Meanwhile, silver has risen by more than 57% since the start of the year, as traders seek refuge in these assets. This shift towards metals is evident on the derivatives exchange, Hyperliquid, where silver futures are approaching $1 billion in daily volume. This surpasses all other assets except Bitcoin and Ethereum, although it is important to note that the funding rates display a negative skew, indicating that traders are shorting into strength rather than purchasing at what might be a peak. With the President of the United States, Donald Trump, imposing fresh 25% tariffs on South Korea on Monday, following a political standoff with the European Union over Greenland last week. The inclination towards risk aversion may well continue. As we contemplate the market's oscillation towards perceived stability, we must reflect on the inherent dynamics of human action and choice that drive these shifts. Are we witnessing a natural recalibration of value perceptions, or merely a temporary retreat in the face of uncertainty? We invite you to share your thoughts and engage in this discussion in the chat. If you believe in what we're doing and want to support BlockSonic's growth, just scan the QR code on the screen or copy the link in the description. Every contribution makes a difference and helps us keep delivering quality, independent, and up-to-date content for you. Bitcoin's path ahead. Hashrate turnaround. The recent decline in Bitcoin's computational power hints at a potential price revival, as historical patterns suggest. The recent downturn in Bitcoin mining due to increased costs from severe weather conditions has brought the focus back on the hash ribbon metric. This indicator, which considers the short-term and long-term averages of hash rate, often signals a price low during miner capitulation periods. Historically, when miners have been compelled to reduce or halt operations, it has preceded periods of Bitcoin price recovery once conditions stabilize. The hash ribbon reflects this interplay, tracking the 30-day and 60-day moving averages of Hashrate. Capitulation is identified when the short-term average dips below the long-term average depicted in light red. The recovery phase is marked when the 30-day average surpasses the 60-day, shown in darker red. A shift from negative to positive price momentum, transitioning from dark red to white, has historically aligned with strategic buying opportunities. The computational power securing the Bitcoin blockchain has decreased by approximately 20%, from about 1.2 zettahash per second to around 950 exahashes per second. The upcoming difficulty adjustment, aimed at maintaining steady 10-minute block times, is predicted to decrease by about 17%. This would represent the most significant difficulty reduction since July 2021, following China's prohibition of Bitcoin mining. The hash ribbon last indicated capitulation in late November, when Bitcoin hit a low near $80,000. The price now hovers around $88,000. A similar pattern was observed in mid-2024. After a hash ribbon, capitulation, and a yen carry trade unwind, Bitcoin bottomed near $49,000 in August before surging to $100,000 the following January. During the downfall of the cryptocurrency exchange, FTTX in 2022, Bitcoin reached a low near $15,000 amid minor capitulation. Once the hash ribbon stabilized, the price rebounded to approximately $22,000. The pressing question is whether this pattern will recur, leading Bitcoin into a new phase of expansion as the hash rate and the hash ribbon begin to stabilize. As we ponder this recurring pattern, what insights can we glean about the resilience and adaptability of decentralized networks in the face of external disruptions? Share your thoughts and join the discussion in the chat. Embracing market turbulence, a new era of volatility trading. Exploring the gateway to crypto volatility through innovative contracts. Polymarket has unveiled a novel approach for engaging with the dynamic nature of the cryptocurrency market, launching contracts linked to Volmex's Bitcoin and Ethereum volatility indices. This platform invites participants to speculate on market fluctuations, broadening access to a realm traditionally reserved for well-capitalized institutions. At the heart of this innovation are two pivotal contracts. What will the Bitcoin Volatility Index reach in 2026? And what will the Ethereum Volatility Index reach in 2026? These contracts, introduced on a Monday at precisely 4:13 in the afternoon Eastern Time, create an opportunity for market participants to engage with volatility indices of 30 days. The contracts operate on straightforward terms. They resolve to yes if any single-minute price chart for Volmex's indices tied to Bitcoin and Ethereum meets or surpasses a designated threshold by the end of December 31st. 23:59. A 1-minute price chart captures the market's rapid movements over a brief 60-second interval, echoing the structure of a candle with its distinct body and wicks. By purchasing yes shares, participants position themselves to benefit from anticipated market turbulence, while no shares signal an expectation of stability. This mechanism empowers individuals to engage with price volatility independent of directional market movements. Polymarket's initiative democratizes access to volatility trading, simplifying participation in an arena historically dominated by complex strategies and significant financial resources. This strategic move represents a significant advancement for Volmex, marking a milestone in the broader landscape of crypto derivatives. Cautionary, the visionary behind Volmex Labs, articulated the significance of this development, highlighting the partnership's role in integrating institutional-grade volatility benchmarks into an accessible prediction market framework. This evolution simplifies the process for traders and investors to express their perspectives on cryptocurrency volatility. Initial trading activity within these contracts indicates a 35% probability that Bitcoin's 30-day implied volatility index will surge to 80%, doubling from its current 40% standing. Similarly, the Ethereum market anticipates volatility to escalate to 90% from its existing 50% level. An intriguing development is the evolving relationship between Bitcoin's implied volatility and its spot price, which has leaned towards a negative correlation since the introduction of spot exchange-traded funds in the United States 2 years ago. This shift implies that heightened volatility is more inclined to coincide with a decline in spot prices rather than an upward rally. In reflecting on these developments, we recognize the transformative potential of decentralizing access to volatility trading. As individuals navigate the complexities of market fluctuations, what insights can be gained from engaging directly with volatility indices? We invite you to share your thoughts and join the discussion in the chat. And don't forget to subscribe to the channel, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Bitcoin lingers below highs as gold shines brightly. Bitcoin faces pressure as investors seek refuge in gold amidst looming financial events. In the intricate dance of global markets, Bitcoin finds itself ensnared below the $88,500 threshold as the week unfolds, reflecting a broader hesitance across digital tokens. Investors, wary of impending decisions by the Federal Reserve and the anticipated earnings from leading technology giants, cast their gaze towards the time-tested allure of gold and silver. In the early hours of Asian trading, Bitcoin hovered around $88,400, marking a modest decline from the previous day and approximately 4% down over the past week. Meanwhile, Ethereum lingered near $2,940, with Solana, XRP, and Dogecoin echoing this cautious sentiment, each experiencing slight downturns. In an intriguing contrast, silver retracted from its zenith witnessed in late United States trading, after experiencing its most significant surge since the financial upheaval of 2008. Gold, momentarily surpassing $5,000 an ounce, showcased the volatility that often accompanies its rally. Despite the fluctuations, silver concluded Monday with a 0.6% gain, following an extraordinary 14% intraday leap that briefly propelled it beyond $117 an ounce. The cryptocurrency sphere, however, remains on the sidelines of this broader macroeconomic narrative. Despite favorable conditions such as declining real yields, a weakening dollar, and escalating geopolitical tensions boosting equities and precious metals, Bitcoin struggles to reclaim its October highs. This divergence underscores the perception of cryptocurrencies as more akin to high beta assets swayed by liquidity and market positioning rather than a stable hedge. As Alex Kupcikovich, the chief market analyst at FXPO, elucidates, cryptocurrencies persist as a trailing category of risk-sensitive assets, falling short in comparison to metals and dominant global currencies. The bearish technical outlook remains pertinent, as Bitcoin lingers below critical moving averages, showing no inclination to breach its recent support levels. Anticipation builds as the Federal Reserve's policy meeting approaches, with expectations of maintaining interest rates steady. Concurrently, the earnings reports from key technology giants could challenge the sustainability of the AI-driven equity surge. These developments are poised to act as catalysts, potentially altering risk appetites and influencing the cryptocurrency markets. In this climate of uncertainty, Bitcoin's resurgence seems increasingly contingent on broader market reactions to the Federal Reserve's pronouncements and big tech's financial outcomes rather than internal cryptocurrency developments. Until clarity emerges, Bitcoin appears tethered to its current range, drifting amidst investor hesitance. As we ponder these dynamics, we must ask ourselves, in a world where financial landscapes shift with every decision and announcement, how can cryptocurrencies establish themselves as reliable assets amidst traditional giants? We invite you to share your insights and join the conversation in the chat. Silver's rise in crypto. A new chapter in market dynamics. Silver's trading surge on hyperliquid signals a shift as Bitcoin remains static. Silver has emerged as a focal point on hyperliquid, reflecting a nuanced transformation in the utilization of crypto derivatives platforms amidst Bitcoin's struggle for momentum. The silver USDC contract has ascended to prominence, trading at approximately $110 during Asian market hours, with an impressive volume of nearly $994 million over 24 hours. Open interest approaches $154.5 million, while funding remains slightly negative, indicating robust turnover and balanced positioning rather than a singular directional bet. This configuration aligns more with a market oriented toward volatility management and hedging rather than speculative length. What captures attention is not merely silver's price, but its significant presence. Silver trails only behind Bitcoin, and Ethereum pairs in volume, surpassing Sol and XRP. When a commodity contract rivals major crypto assets for volume on a decentralized platform, it suggests that traders are utilizing crypto infrastructure to articulate perspectives that Bitcoin and Ethereum no longer capture effectively. Essentially, crypto mechanisms are being adapted for broader macroeconomic trades. This context elucidates why Bitcoin remains in stasis. Data from Glassnode illustrates Bitcoin caught in a defensive equilibrium The spot cumulative volume delta has turned sharply negative, indicating sellers are capitalizing on rallies. Exchange-traded fund flows have diminished, removing a crucial source of increased demand. In derivatives, open interest has declined, funding is inconsistent, and options skew has risen, indicating a growing preference for downside protection over conviction in upward movement. The result is a market where Bitcoin withstands pressure without collapsing, but also fails to establish a trend. Price stability near $88,000 conceals the absence of aggressive buyers and a hesitance to employ leverage. Ethereum's relative underperformance underscores this sentiment. Risk appetite does not extend to less established assets. Bitcoin is not being abandoned. It is merely sidelined. The surge in silver trading on Hyperliquid is among the clearest indicators of where uncertainty is currently being assessed. Bitcoin hovers near $88,000, trading sideways as persistent sell pressure and cautious positioning limit rallies despite the lack of panic selling. Ethereum trades around $2,300, down on the week, and trailing Bitcoin as leverage and risk appetite remain restrained. Gold continues its breakout, up approximately 15% over the past 30 days and more than 50% over 6 months. Reinforcing the macro stress trade, evident in silver as capital gravitates towards hard assets rather than crypto alternatives. Nikkei 225. Japan's Nikkei 225 remained nearly flat in Asian trading, despite South Korean auto stocks experiencing volatility due to renewed tariff threats from the United States. With regional markets mixed and chip-led gains in Seoul and Australia, offsetting weakness in China. As markets evolve, we must ponder. Are we witnessing merely a fleeting shift, or does silver's ascent on crypto platforms herald a new era of market dynamics? Share your insights and join the conversation in the chat. And don't forget to subscribe to the channel, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Bitcoin's unyielding stance amidst precious metals frenzy. Gold and silver's monumental surge reveals Bitcoin's resilience. Bitcoin, maintaining its steadfast position near $88,000, witnessed precious metals like gold and silver reaching unprecedented highs before slightly retracting. As the digital currency world held its breath, Bitcoin hovered around $88,000 on Monday. Meanwhile, gold and silver surged to new peaks, only to retract slightly thereafter. Bitcoin's minor recovery from its typical weekend volatility contrasted with its decline from approximately $90,000 late Friday. The looming possibility of fiscal constraints by the end of January, hinting at liquidity challenges, spurred the Sunday downturn. In stark contrast, enthusiasts of precious metals remained undeterred. Gold leapt past $5,000 and then $5,100 for the first time on Sunday and Monday, with silver peaking at $118. Signs of fatigue, however, are emerging. Gold has retreated to $5,043, marking a 1.3% daily increase, while silver settled at $108, still up by 7%. Gold and silver effortlessly amassing an entire Bitcoin market cap in mere hours, observed the renowned crypto analyst Will Clemneng, capturing the sentiment among Bitcoin investors. The index tracking the US dollar descended to its weakest point since September door. This occurred as the Federal Reserve collaborated with the Bank of Japan in currency interventions aimed at strengthening the yen against the dollar. At 154.07 yen, the dollar declined by more than 1% on Monday. Bitcoin's tepid response to the dollar's weakness has left traders wary in the short term, as Swissblock analysts noted. The recent market behavior underscores a bearish perspective, they remarked in a Monday report. A definitive drop below the $84,500 support level might herald a more significant downturn towards $74,000. They cautioned. Nonetheless, they highlighted that if this support remains intact while risk metrics stabilize, it could present a tantalizing opportunity for bullish investors. Bitfinex analysts echoed the cautious sentiment, suggesting Bitcoin will likely oscillate between $85,000 and $94,500. They pointed out tactical shifts in the options market, where traders are reacting to immediate risks without anticipating long-term volatility. This implies traders are accounting for temporary risks rather than ongoing disruptions in market dynamics, the analysts mentioned in a Monday communication. The persistent outflow from spot Bitcoin ETFs adds further pressure. Over the past week, outflows surpassed $1.3 billion, indicating a waning risk appetite among investors. Unveiled, Schwab's director of crypto research and strategy, sees limited prospects for sustained upward move without improvements in on-chain activity. ETF inflows, derivatives positioning, or miner engagement. A more substantial catalyst, in his view, would be the implementation of the Clarity Act, though its progress might be hindered by potential fiscal disruptions. Until its enactment, he anticipates a narrow trading range between the low $80,000 and mid-$90,000, with major institutional players remaining cautious. As we contemplate these unfolding dynamics, we must ask ourselves, in a world where markets are constantly influenced by external forces, how do we ensure that our understanding of value remains rooted in individual choice and voluntary exchange? Share your thoughts and join the conversation in the chat. Emerging crypto dynamics. ARK Invest's bold ETF move. ARK Invest's latest ETF filing reveals a strategic leap into crypto investment, pushing the boundaries of traditional finance. ARK Invest, under the leadership of Cathie Wood, has boldly stepped into the realm of cryptocurrency with its proposal for two innovative exchange-traded funds. These funds aim to mirror the CoinDesk 20, an index representing the most liquid digital assets such as Bitcoin, Ethereum, Solana, XRP, and Cardano. Instead of direct crypto holdings, these ETFs would strategically leverage cash-settled, regulated futures contracts to replicate the index's daily fluctuations. One fund intends to track the entire CoinDesk 20, while the other seeks to exclude Bitcoin by balancing long index futures with short Bitcoin futures. These offerings are structured to provide investors with diversified exposure to crypto assets without the complexities of direct ownership or custodial concerns. Although intended to list on NYSE, the exchange has yet to file the necessary 19B4 form with the Securities and Exchange Commission, a crucial step for approval. ARK's filings join those of asset managers like WisdomTree and ProShares, who have similarly proposed crypto index ETFs based on regulated futures. With no approvals thus far, a significant opportunity remains for diversified crypto exposure through ETFs. Reflecting on this strategic move by ARK Invest, we see an unfolding narrative of financial innovation and market adaptation. The reliance on regulated futures, rather than direct asset holdings, underscores a nuanced understanding of risk management in an evolving market landscape. It also highlights the entrepreneurial spirit seeking new pathways for growth within the constraints of existing regulatory frameworks. In this light, how do we, as observers and participants in this economic evolution, perceive the future of financial innovation in the crypto space? We invite you to share your thoughts and join the discussion in the chat. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. CoreWeave's momentum, a critical turning point for Bitcoin miners. Bitcoin miners face intensifying challenges as CoreWeave attracts major investments, reshaping AI infrastructure dynamics. Recent developments in the realm of high-performance computing have unveiled a pivotal moment for Bitcoin miners. With NVIDIA's substantial $2 billion infusion into CoreWeave, a significant shift is underway, highlighting both opportunities and challenges for those in the Bitcoin mining sector. This investment underscores the growing demand for advanced computing solutions, driven by the expansion of AI applications. Yet simultaneously poses a formidable challenge to independent miners aiming to reposition themselves as infrastructure providers within this burgeoning space. In the wake of this announcement, entities such as Cipher Mining, CleanSpark, Iron, and TeraWolf experienced declines ranging from 5% to 9%. These market reactions reflect investor apprehensions about CoreWeave's potential to outpace other players in the AI infrastructure market, thereby constraining growth prospects for smaller competitors. As articulated by James Van Straten, a senior analyst, the strategic alliance between NVIDIA and CoreWeave signals an increasing allocation of GPU resources towards this partnership. This dynamic could potentially limit funding opportunities for independent miners seeking to pivot into AI infrastructure, as the $2 billion capital boost is poised to considerably enhance CoreWeave's AI compute capacity, intensifying competition and pressuring margins and market share for smaller entities. CoreWeave's valuation, already at $53 billion, is now approximately half of the peak valuation of the entire Bitcoin AI mining sector as of October. This suggests an inevitable trend towards consolidation within this maturing industry. But meanwhile, CleanSpark shares reflected a 9% drop due to perceived operational risks and governance concerns, further compounding the challenges faced by firms transitioning towards AI. Conversely, Core Scientific and Hashrate have shown resilience amidst these shifts. Both companies have diversified into AI hosting and high-performance computing, providing them with a competitive edge as demand for computing power surges. Their strategic positioning underscores the adaptability required in the face of evolving market dynamics. The transition towards AI infrastructure is not a novel concept. Bitcoin miners, once focused solely on blockchain validation, have been adapting their operations to accommodate more profitable workloads as mining rewards diminish and power costs escalate. NVIDIA's recent maneuver, however, indicates a trend where resources are increasingly directed towards larger, cohesive players like CoreWeave, compelling smaller firms to either adapt or face consolidation. As we reflect on these developments, we must ask, in a landscape where consolidation appears inevitable, will smaller Bitcoin miners find innovative pathways to thrive, or will they be absorbed by larger players? We invite you to share your insights and engage in this discussion in the chat. BlackRock ventures boldly into Bitcoin income strategy. BlackRock's strategic move introduces a new income-focused Bitcoin ETF, aiming to blend traditional investment approaches with cryptocurrency's potential. BlackRock, the global asset management giant, is diving deeper into the cryptocurrency exchange-traded fund market by proposing an innovative income strategy based on Bitcoin exposure. The company, managing an impressive $12.5 trillion in assets, has filed with the United States Securities and Exchange Commission to list the iShares Bitcoin Premium Income ETF. This proposed fund aims to actively manage Bitcoin exposure, either directly or through holdings in BlackRock's existing iShares Bitcoin Trust, while generating income by implementing a covered call strategy on that exposure. This strategy, common in traditional stock income funds, allows the fund to generate income by selling call options, granting a counterparty the right to purchase the underlying asset at a predetermined price. Although the fund's ticker or fee structure remains undefined, it will actively oversee this covered call strategy, distributing the generated premiums to investors as income, effectively trading potential price appreciation for income generation. Funds with similar income strategies include the Roundhill Bitcoin Covered Call Strategy ETF, Amplify Bitcoin Max Income Covered Call ETF, and the NEOS Bitcoin High Income ETF. BlackRock's entry into this space is notable for its sheer scale and connection to the iShares Bitcoin Trust, which already dominates the Bitcoin ETF market with over $69.7 billion in assets under management. While some covered call ETFs may dilute net asset value due to their high distribution rates, BlackRock's involvement signals confidence in balancing income generation with Bitcoin's inherent volatility. Despite offering higher yields, Bitcoin-focused income ETFs have historically underperformed Bitcoin itself, reflecting the trade-off between income and potential capital gains. In the past year, Bitcoin income ETFs have faced declines, underlining the inherent risk in pursuing yields in a volatile market. As we observe these developments, we must consider: is the pursuit of income through innovative financial products worth the potential trade-offs in a volatile asset class? We invite you to share your thoughts and engage in this discussion in the chat. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. U.S. crypto market faces structural hurdles amid legislative stalemate. The ongoing lack of clear U.S. crypto market legislation prolongs uncertainty, potentially favoring Bitcoin's established status over more volatile sectors. Should legislative progress on U.S. crypto market structure falter this year, the environment will not revert to previous enforcement intensities, but the absence will maintain structural constraints. This comes as global adoption and institutional interest are on the rise, according to insights from Wall Street broker Benchmark. In a comprehensive analysis, analyst Mark Palmer highlights that without legislative clarity, a persistent structural risk premium will overshadow much of the digital asset landscape. This will likely restrain growth and valuation potential for U.S.-based platforms. Palmer suggests that while the maturation of crypto will be delayed rather than halted, the U.S. market may continue to underperform in its potential. Investors are expected to gravitate towards Bitcoin-centric assets, robust balance sheets, and cash-flowing infrastructure, avoiding regulatory-sensitive sectors like exchanges, decentralized finance, and alternative coins. The intended legislation aims to clarify U.S. crypto market structure by categorizing digital assets as commodities or securities and delineating oversight between the Securities and Exchange Commission and the Commodity Futures Trading Commission. While the House has moved the discussion forward, Senate negotiations are proving challenging, risking delays into the following year. Market participants are already factoring in these timing risks. Without a definitive market structure bill, exchanges will likely contend with ongoing listing uncertainties, elevated compliance costs, and restrictions on higher margin product expansions. Additionally, the monetization of stablecoins might face setbacks due to unresolved yield and distribution regulations. Bitcoin and Bitcoin-focused treasury entities are perceived as more insulated, thanks to Bitcoin's established status as a commodity. Miners and energy-backed infrastructure remain less vulnerable, while decentralized finance and smart contract platforms face the greatest challenges due to ongoing regulatory ambiguity. Despite these challenges, Palmer maintains a cautious optimism that some form of market structure legislation will eventually pass, potentially mitigating regulatory risks and promoting broader institutional engagement. As we navigate these unfolding developments, we must ask ourselves, how might the absence of legislative clarity reshape the future landscape of digital assets in the U.S.? Share your thoughts and join the conversation in the chat. Bitcoin acquisition strategy, a shift in pace. Bitcoin holdings continue to surge despite slower acquisition strategy. In a realm where individual choice propels markets, strategy demonstrates the dynamism of entrepreneurial discovery. Last week, Strategy acquired 2,932 Bitcoin, totaling $264 million, reflecting a tempered approach compared to the billion-dollar acquisitions of preceding weeks. This decision, led by Executive Chairman Michael Saylor, highlights the intricate dance between opportunity and scarcity. The firm's aggregate Bitcoin holdings now encompass 712,647 Bitcoin, acquired at $54.9 billion. The average acquisition price stands at $76,037 per Bitcoin. As of the latest transactions, Bitcoin's market price hovers around $87,500, valuing Strategy's holdings at over $62 billion. This exemplifies the market's capability to adapt and realign resources through spontaneous coordination. Interestingly, the majority of last week's acquisitions were financed by common stock sales, with an additional $7 million raised from its SRC series of preferred stock. This maneuver underscores the intricate balance of leveraging financial instruments to optimize market positioning while maintaining fiscal prudence. Reflecting on this, we observe the broader implications of such strategic actions. They encapsulate the essence of voluntary exchange and the relentless pursuit of wealth creation. In a market where prices serve as dynamic signals, Strategy's calculated engagement underscores the significance of entrepreneurial foresight in navigating economic landscapes. Does the current strategy adopted by Strategy reflect a sustainable model of growth, or does it portend challenges inherent in such large-scale acquisitions? We invite you to ponder this question and share your thoughts in the chat. Bitcoin's uneasy path amid financial tides. Prepare for January 26, 2026, with a deep dive into the economic currents shaping our world. Bitcoin faces a turbulent path, reflecting the challenges of operating within an environment where fiscal instability and external interferences shape market dynamics. As Bitcoin falters, slipping 0.8% to below $88,000, and Ethereum follows suit with a 1.6% decline, we witness a divergence from traditional safe haven assets. The broader index echoes this sentiment with a retreat of 1.54%. The yen emerges as a focal point, rallying 1.4% against the dollar after Prime Minister Sane Takaichi's vow to counter speculative market behavior. This interventionist tone pressures traders to reassess positions, especially as the Japanese 10-year bond yield touches a 27-year high. In tandem, the Federal Reserve Bank of New York's rate check signals a potential collaboration with Japan, unsettling investors and prompting a shift away from risk-laden assets. The narrative draws parallels with historical financial phenomena, as highlighted by Michael Berry's comment on Japanese bond yields nearing global rates. The implication is significant. Nearly $5 trillion of overseas capital could be repatriated, disrupting risk assets and leading to declines in indices like the Nikkei 25 and Nasdaq. Curiously, this capital does not pivot towards Bitcoin, but instead seeks refuge in gold, which has surpassed $5,000 per ounce. The allure of gold, with its historical liquidity and stability, contrasts with Bitcoin's perceived volatility and liquidity challenges, as noted by Greg Cipollaro. Blockchain data reveals further distress as long-term Bitcoin holders begin to offload at a loss, mirroring October 2023's market sentiment. This week's Federal Reserve meeting holds potential insights as interest rates remain steady, yet the guidance of Chair Jerome Powell will be scrutinized. Concurrently, the looming threat of a United States government shutdown and major tech earnings reports add layers of complexity. As we navigate these intricate financial landscapes, we are compelled to ponder, Are we witnessing a temporary shift in asset preferences, or is this a more profound realignment in how we perceive risk and value? We invite you to engage in this discussion and share your thoughts in the chat. Bitcoin's unprecedented decline. A turning point? Bitcoin teeters on the edge of a transformative moment as it faces an unprecedented streak of monthly losses, a scenario not witnessed since the market's tumultuous period from 2018 to 2019. With just a week remaining in January, Bitcoin's value hovers around $87,000, marking a potential fourth consecutive month of decline. This persistent downturn follows negative monthly closes in October, November, and December, a stark departure from Bitcoin's October peak. The asset's value has plummeted approximately 36% from its highest point during this period, underscoring the severity of this correction. Curiously, even during the severe downturn of 2022, when Bitcoin's value plummeted from $69,000 to $15,000 amid tightening monetary policies and industry-specific challenges, it did not endure more than 3 consecutive months of decline. This historical comparison accentuates the unprecedented nature of the current situation should January conclude in the red die. In contrast to the spot market's weakness, derivatives markets exhibit tentative optimism. Data from Deribit indicates a slight upward interest as the month draws to a close. As the options expiry on January 30th approaches, with total open interest nearing $8.5 billion on Deribit, the $100,000 call option holds the highest notional value, close to $900 million. This suggests a significant group of traders anticipates a rebound to the 6-figure level. The concept of max pain, where the largest number of options contracts expire worthless, sits near $90,000, potentially exerting a gravitational pull toward this level as expiration approaches. Reflecting on these developments, we are reminded of the intricate dance between market expectations and reality. The current scenario challenges us to consider the broader implications of sustained declines and the potential for a market recalibration. Amidst this uncertainty, we must ask ourselves, are we witnessing a fundamental shift in market dynamics, or is this a temporary aberration? We invite you to share your thoughts and join the conversation in the chat. Bitcoin surge propels Meta and its revenue projections skyward due to a remarkable leap in Bitcoin-driven profits leads Metaplanet to anticipate a revenue surge beyond $100 million for the financial year 2026, with a staggering 97.5% of sales emerging from its Bitcoin-based ventures. As we witness the unfolding narrative of Metaplanet, a Tokyo-listed entity, we find its revenue poised to nearly double this cycle following a turbulent conclusion to 2025. This period saw the enterprise endure substantial paper loss exceeding 100 billion yen, equivalent to $650 million, due to Bitcoin's sharp decline. Metaplanet has recalibrated its full-year forecast for the financial year 2025, projecting significantly higher operating income and sales for the upcoming year. This optimism is largely driven by its flourishing Bitcoin income generation segment, a business unit that leverages the firm's vast Bitcoin holdings. Approximately 35,102 Bitcoin, valued at over $3 billion, as collateral for revenue generation through intricate options strategies. The strategic issuance of Class B perpetual preferred equity, known as Mercury, alongside the establishment of a $500 million credit facility, has fortified Metaplanet's capital structure, mitigating dependence on share price fluctuations. Further stability is introduced with the senior class, a preferred share, aptly named Mars. For the financial year 2025, revenue reached 8.9 billion yen, marking a 31% increase from an earlier projection of 6.8 billion yen. Operating income similarly rose by 34% to 6.3 billion yen. Nevertheless, a write-down of 104.6 billion yen on Bitcoin holdings in the fourth quarter compelled Metaplanet to declare an ordinary loss of 98.6 billion yen and a net loss of 76.6 billion yen. Despite this accounting loss, Metaplanet maintains that it does not compromise cash flows or foundational business dynamics. Notably, the Bitcoin yield, defined as the expansion of Bitcoin holdings per share, soared by 568% throughout the year despite share dilution. Looking forward, Metaplanet projects 16 billion yen in revenue, alongside 11.4 billion yen in operating income for the financial year 2026. This outlook is predominantly driven by its Bitcoin-centric activities, which are expected to contribute 97.5% of sales. The remaining 400 million is attributed to its hotel business, which Metaplanet asserts remains steadfast. Although Metaplanet refrained from offering net income guidance for 2026 due to Bitcoin price volatility, it reiterated confidence in its Bitcoin strategy, underscoring the acquisition and yield generation as aligned with long-term goals. As we reflect on these developments, we observe the intricate dance of market forces and individual enterprise strategies, where the vast potential of decentralized assets unfolds through calculated human action. In this theater of economic phenomena, we must ponder: how might the decentralized nature of Bitcoin and its integration into traditional business models reshape our economic landscape? We invite you to join the conversation and share your insights in the chat. Thank you so much for following BlockSonic today. See you soon with more news analysis and market alerts. Keep an eye on Bitcoin and continue listening to the sound of the blockchain.